What direction is the housing market headed today? That is the question that everybody is wondering, and rightfully so. In today's video, we are going to break that down with what prices and interest rates are doing today and what you can expect moving into 2023. So let's get right into it. With prices going up as well as interest rates on the rise, affordability is hitting an all-time low and has become a real issue for many potential home buyers. According to the National Association of Realtors, the median home price in the US is up to $391,200. This is a price that we have seen continue to rise. This is the Housing Affordability Index. And if we just focus on the median existing home price here, look at how much this has escalated. In 2019, we were looking at $274. Now we are up, like I said, to that $391 in essentially just a few years. At the same time, take a look at this. The median family income in 2019 was $80,000. Now it is $89,000. So you're seeing the median home price go up by essentially over $100,000 in just a few years. Meanwhile, the median family income only went up by $9,000. Something just doesn't add up there. Then you have interest rates. Over the last 30 days, 30-year conforming interest rates have been at 5.412%. We're seeing some up in the 5.5s, with 15 years as well, almost getting up to 4.5%. Now, keep in mind, these are still historically low, but the panic has set in because in the previous year, we had seen people locking interest rates for 30 years in the twos. Just look at these rate trends. This right here is the past 90 days, so sloped, 180 days, and then just 1 year total. We started out in 2021 in like the low threes, some in the twos. Then we rose up to kind of how high we were, which was like a 30-year conforming for a good credit score was like 5.6%. Now we are starting to see a little bit of a dip there since early May, but interest rates are still predicted to rise. So what does all of this mean for home buyers? Is now still a good time to buy? Let's take a look at what is forecasted for the rest of the year into 2023. Fannie Mae put out a statement saying that home prices are expected to jump up to an additional 11% this year and 3% next year. This article goes on to say that if home prices do jump 10.8% in 2022, it would represent a deceleration from the record 18.8% jump that occurred just last year. That said, it would hardly be a relief for home buyers. In fact, at that rate, it would still be more than double the average annual home appreciation of 4.6% posted since 1987. So let's take a look at this U.S. home price growth. I can already see some of you freaking out because we see statistically, we have been going up and now we are going down. This does not mean housing crash. Let's take a look at this and dive in. On the left, you can see this is U.S. home price growth in percentages. All of these are positive. So this graph right here is showing the appreciation of home prices. In December of 2018, we were still below 4% in price growth. That remains true until the middle of 2020 when we saw a giant spike in home price growth. We went up to 20% in some cases. Now, this is starting to taper down. Fannie Mae is expecting now that we would see probably about a 10.8% growth in home prices this year throughout the rest of 2022. With that then tapering off to about 3.2% next year. So this does not mean that home prices are crashing. This does not necessarily mean that home prices are going down. This means that the growth is slowing down. If we were to see a crash or homes becoming devalued or worth less money, we would see this go below our baseline here and we would start to see negative numbers. So even if we go down to this 3.2% price growth in 2023, that is us getting towards what we have been at since the 80s, a good baseline. That does not mean that we are crashing and burning and your home that you bought last year is now worth way less money. Not what that means at all. Doug Duncan, chief economist at Fannie Mae, said mortgage rates have ratcheted up dramatically over the past few months, and historically, such large movements have ended with a housing slowdown. Consequently, we expect home sales, home prices, and mortgage volumes to cool over the next 2 years. In particular, we expect home price growth to decelerate to a pace more consistent with income growth and interest rates. And remember, nobody knows. I do not know with 100% certainty what the future of the housing market holds. No one knows, even these chief economists for these big companies. We are all just analyzing the data and the signs. So I think it's really important to read out this bottom paragraph, which says, it might be wise to take all housing forecasts, videos you watch, news articles you read, with a grain of salt. Case in point, the COVID-19 recession. During the spring of 2020, both Zillow and CoreLogic published housing forecast models predicting that U.S. home prices would fall by spring 2021. Obviously, the prices haven't fallen, and in fact, home prices went on a record run. To me, what you need to take away from this Fortune article is that home prices are not set to go down or crash anytime soon. So it's not worth putting off your home purchase to wait around for a better price. Let's take a look at what you can expect from interest rates. By the end of 2022, experts anticipate that the 30-year fixed rate could land anywhere between 4.8 and 7%. Right now, we are already seeing interest rates like we looked at in like the mid 5.5% range. So I don't know. It is looking like we might be on the higher end towards that 7% by the end of the year. There are several factors that continue to push the mortgage rates up. The first thing is the continued high rate of inflation, which is currently around 8.3%. Second, you have the Fed, who has said that more rate hikes should be expected throughout this year. That is probably going to impact interest rates and make them go up as well. And then third, you have this global unpredictability related to the war in Ukraine, as well as the stock markets. Right now, the signs are pointing towards interest rates going up and prices going up. So you can listen to whoever you want. And if you want to hold out for some mega crash, you can. But all everyone is saying, and what I'm saying, is that if you have the means to financially set yourself up and buy a house now, you might as well do it, because it's not going to be advantageous for you to try to shift your whole home buying situation and wait for this perfect little pocket of time in the market if you're going to be waiting for a long time. And I think it's gonna be a long, long time. The absolute best time to buy real estate, whether it's a primary residence, whether it's an investment property, is when it is financially going to make sense for you as the buyer. That may be now, and that may not be now. The advantage to buying sooner rather than later is that home prices are still going to be appreciating at a faster than usual rate. So if you buy a house in 2022, you are going to be able to ride up some of that very fast home equity that you are going to be able to get. Now, if you do decide to wait, that is okay too. But as of right now, the signs are showing that you are going to be buying potentially the same house at just a higher price point, and your costs associated with buying that house that you'll be paying in interest, that you'll be paying in closing fees, are going to be higher. If you have additional questions, let me know in the comments below. I will be making lots more housing market videos, just keeping you guys updated as we progress through 2022 into 2023. As always, if you are not following me on Instagram, please go over and do that as well. I have been posting little snippets of the market, as well as some informational things to know for buyers, sellers, and documenting flipping a house, building a house, all sorts of behind the scenes information on there. So if you haven't already, make sure to check that out. I'm Nicole Nark, Arkansas real estate broker, with videos to help you find your way home, and I will see you in the next one.